All right, I think we're live. So what we decided to do is to switch over to StreamYard, and instead of doing a webinar through Zoom, I decided to just do it through StreamYard so that we can actually hit YouTube and Facebook groups and everything all at once. I said, F the registration. Let's just push it out there. We're going to be talking about how to analyze or underwrite commercial real estate properties. For example, we have a deal closing tomorrow. We're actually wholesaling a commercial property, a mobile home park. I'm sure we'll talk about it a little bit throughout today, but it's a six-figure wholesale fee from what is it, 12? I think it's 12 or 8, 10 trailers park. I don't remember exactly what it is. 11. So we're going to teach you guys how we analyzed it. We're going to talk about other deals. I myself have invested into real estate transactions that are at the commercial level, 150 unit buildings, 186 unit buildings. Jake, who is coming on, is actually invested into even more commercial properties than I am, because he's a managing partner in them. Compared to me, I just put money into them. So I kind of look at it from a different perspective. He sees a lot of the inner workings to make things happen. He has, and he'll talk about himself when he comes on, but he has self-storage unit facilities. He has mobile home parks. He's got a mixture of everything on a commercial side as well as single family residence. So what we're going to do today is go through some slides and talk about how to underwrite these deals, and some of the things you got to think about. The reason why this webinar is even happening to start with is because we plan on having a commercial in-person mastermind or workshop over this weekend, and the dates just did not line up for anybody. They had other stuff going on, so we decided to just do this webinar, let people kind of have some information, since we were going to be giving it anyway. But we just can't give everything now because, well, we only have 2 hours. So feel free to chime in, ask questions in the chat throughout this time frame. This is really spontaneous, so I'm sure it's not going to be a ton of people. But the people who rewatch this as it kind of trickles through the internet, hopefully you get some value from it as well. I'm going to go ahead and step off now and let Jake come in, and we'll get kicking off here. Let me switch over to where the slides is and show you when you want to share. You'll just click share here and then share screen. And actually, I'll just go ahead and start sharing, and then I'll just remove it. So you can just add to stream on the bottom right corner here. If you want to add the slides to the stream, you just do that. If you want to remove them, just come back and remove, just like that.
Add to stream. Okay.
Click add to stream and it'll start sharing a screen, and then you can just click over to here and then do your present. And then if you when you come back, you can just click remove from stream here.
Okay.
Cool. Dope, man. Having some Zoom issues. Glad you're live on Facebook. Yeah, Zoom was being weird, so we just said, you know what, we're just gonna come here instead. So hopefully it's going. Is it going on here? Yeah, here instead of Zoom. So here instead of Zoom. I'm gonna go live in a Facebook group on my own post, so it'll give people notifications as well. But anyway, this is Jake. You guys enjoy your time with him in the slides. And if you want to get on his good side, just talk about fishing. Cool.
Cool. Thanks, Tyler. Hey guys, how you doing? Jake Chambers. Some of you guys know me. Might have met some of you guys at the SIFT Mastermind a couple weeks ago. So anybody out there that I met it and talked to, it was great. Hopefully you're on here, get some more information. We just kind of jumped into it briefly at the mastermind. I gave a little presentation on raising private capital for your company, whether it's for wholesaling or flipping or whatever. So a little bit quick background on me. If you don't know me, I'm actually getting out of the Marine Corps here in about 2 weeks. 15 years, active duty Cobra pilot by trade. So what am I doing getting into real estate? Well, I'm lost, basically got passed over. So I had to find some way to invest in some bigger stuff. Or some other things. Everybody else, all my other buddies are going to the airlines. So being the proverbial, you know, guy that kind of goes against the grain, which is probably why I'm getting forced out of the Marine Corps. But anyway, so I decided to try real estate. So through that process, long story short, did a couple burrs, and then I had an opportunity to invest in a small mobile home park in my hometown here. So I decided to hop in on that, and learned a lot, and it helped me to then buy a couple more mobile home parks. We actually just last week closed on a apartment complex, and we've bought a storage facility. So we've closed about 200 units so far this year. We've got a little over 300 altogether that I'm either fully an owner of or in some type of sponsorship or general partner role throughout the Northwest Panhandle as well as Northwest Indiana, specifically the Gary market. So anyway, that's a little bit about me. So enough about me though. What I'm here to talk to you guys today about is how to. So we all underwrite deals, right? So we get a lead that comes in. It's a 3,200 square feet or 1,500 square feet, let's call it. Needs it needs some repairs. We got to figure out what it needs. It need a roof, need plumbing, electrical, whatever, right? Floors, paint. What's the area? What's the market? What's the comps, right? We look at all we do is go to Zillow, PropStream, do a CMA if we've got an access or a partnership with another realtor where we can get the value of it, and it's based off of comps, price per square foot, right? Well, there is a similar way to or commercial real estate also has values that's pulled off of. Hold on a second, let me close this. That's on your screen. Hopefully not. It'll pop up. There's still other properties and other things that affect your real estate deal, just like comparable properties. However, it is much different and much more involved in commercial real estate. So some of you guys know. Actually, let me ask you this really quick. I wanted to ask you this. Go ahead and post really quick. Just comment on if any of you guys or just any of you guys what your experience is with commercial real estate. Have you done any deals? Have you wholesaled any deals? Have you bought any? Are you a limited partner? You're a general partner? No experience is cool too. I'm kind of curious to see where you guys all are at. I was actually quite pleasantly surprised to see a few guys at the mastermind that we had last month that had some pretty significant experience. So just a little curious. Put it in the comments, and we'll go back to that in a little bit. So if you guys have experience with commercial real estate and are a little bit experienced, go ahead and hold off on spoiling the fun on some of these things for now. Some of the definitions and things that we look for, because you guys are already in the know, but that doesn't mean we can't learn anything, right? So anyway, when it comes to commercial real estate, I'm going to go ahead and get my ugly face off of here. And I'm going. Shit. Where's my screen? Gotta pull up. Sorry, this thing is way too fast for me. There we go. All right. Hopefully you guys can see this. Okay, stream. It looks like I'm sharing. So I'm gonna go back really quick. Somebody tell me if you can see this or not. Can you guys see what I just had up there? That screen. Let's see where we're at. Can you guys see it? Could you guys see that screen when I had it up there a minute ago? Actually, give me. Okay, cool. Thanks. Thank you, Claudio. Appreciate it. I'm gonna go back to that now. Okay, just wanted to make sure. Okay. So like I said, the title of this one is going to be Underwriting a Commercial Deal. Go to the presentation here. So the title of our mastermind that we're going to be doing eventually here that we tried to get to was how to get a six-figure a deal, right? The six-figure deal. And what I mean by that is how do you get either an assignment or some multiple six-figure back-end sale or equity in a commercial deal, right? Um, so first of all, we need to kind of define what is a commercial property. Well, a commercial property, or at least how it's defined, is a property that is used for commercial means, i.e., whether it is a large multifamily, whether it is industry, whether it is self-storage facilities, stuff like that. So there's quite a few, right? On the multifamily stuff, if you are more than 4 units, so 5 units or more, that is considered commercial, right? Um, Self storage, office spaces, you know, industrial stuff like that. That's obvious. That's very clear that is commercial. I think I am. Am I not now?
I'm just
Oh,
make sure
they said I was there. Am I not?
share.
I was. Sorry, guys. Yes, we could.
to where you put this here.
Then I'm just gonna leave it.
Now you so now you can see it's
Okay. Now do I need to go to present or can
yeah,
I? Okay,
present.
got it. Sorry, guys. Okay. All right. So next slide here. All right, so here's some examples of commercial real estate, right? Like this is probably the one that a lot of us are used to see, right? That big apartment complex, or semi big, right? Bunch of places there with a parking lot, something like that. So apartment complexes are considered a form of multifamily real estate. Um, typically defined by or defined by five or more units. Then you got mobile home parks slash RV parks. I'll kind of lump them in. They are functionally can be very different. They can be similar depending on the type of RV park, but as far as we're concerned here, we're considered, multiple movable or semi-movable units on a single piece where you have a land lease, i.e., the homes aren't tied to the real estate, right? So you have real property, which is the land and the infrastructure, and you have the personal property, which is the homes themselves. Okay, um, and you got a office space, right? I'm briefing this from an office space right now. The dojo that we got here in Fort Walton, Florida, Fort Walton Beach, Florida. So that's a form. We've got multiple offices that our own personal company runs, as well as some multifamily rentals that we have as well here. So okay, self storage. Um, that is actually those the apartment complex, those mobile homes, and this is actually properties that we own, that I'm in some way, shape, or form involved in, whether as they're all GPs in, or I own wholly, right? Um, so yeah, this is pretty straightforward. These are pretty awesome. I like them. If you get any of these, send them my way. And you got industrial, right? Industrial is going to be like data management facilities, manufacturing, things like that. And then restaurants can be really tough, right? We kind of saw last year when it did to a lot of restaurants and a lot of other small business owners, can be profitable. They typically, unless you are very adamant about owning the just basically setting management in place, they're very time intensive, and management intensive to make sure that their operation or their perform at the top level. But they can be profitable if you do it right. And then we have what's called a triple net lease. So everybody knows the CVS, the Walgreens, well, not McDonald's. It's actually a bad example there. It's a good and bad example, but it's kind of an internal thing. But basically, what a triple net is, are these big uh, properties. You see these big strip malls and stuff like that. Is where the net you'll also hear it called a net, where the property or the tenant, in this case CVS, is paying for rent for the building, and they're also covering the insurance, and they're also covering all maintenance and repairs. And so basically, for the landlord, as far as they're concerned, their lease is their net. So there's no expenses other than their taxes that they have to pay on rental income. So if rent is 500,000 a year, they're going to net 500,000 at the end of the year. Good. All right, cool. Oh, I can lean in. Okay. Sorry, guys. Use my big boy voice here. Okay. So first, before we get started, we kind of need to talk about some definitions, right? Um, they help us to make sure we're speaking the same language. As we all know, that real estate can be its own language, so we need to make sure we understand this. Some of these things you may understand. Definitely, you've probably heard of a lot of these. This mic is just going down. Okay. Anyway, but you might not fully understand them, right? All right. So first, we'll start with cap rate. So the best way to think about cap rate, I'm adjusting this mic here. It keeps going down on me. I don't know what's going on here. Man, all right, I'll just get lower here. The best way to think of cap rate is going to be to think of it like a variable, like pi and pi r squared, right? It's basically a variable that is used per market, as well as as well as in the individual asset class and type and condition, and it's kind of like the price per square foot that we use in residential real estate. So it basically is the market rate, that that particular property that you have will rent for, right? Or excuse me, will trade at on the open market, right? So cap rate is part of the valuation formula. And what I mean by that is you use cap rate, and the NOI, which we'll talk about in a second as well, to determine the value. Um, so it's based off of 100. It's like a percent. So 1.0 would be 100 cap. There are no 100 cap properties, but so typical, let's say if you had a 10 cap property, here's somebody talking about a 10 cap, it's zero point 0.1, right? So you would use that in the formula, and we'll show you that in a second here down at the bottom. So the value equals your NOI, which is your net operating income, divided by the cap rate. So unlike normally how we're taught to buy low, sell high, right? You make your money when you buy, you realize your profits when you sell. Same thing, except for you have to buy at a high cap rate, or you want to buy at a high cap rate if possible. Let's say you buy at a 15 cap and you sell at a 10, because as the number gets smaller, you're essentially dividing by a smaller decimal, right? And as the decimal gets smaller, the top number, or the other side of the equation, gets bigger, right? Because that top line, the NOI, doesn't change. All right, I'm getting crushed here. I don't know this whole. Hold on, give me a second, guys. I gotta adjust this mic because I cannot get it to stay. I don't want to. I'm not a midget. Tell you what, I'm gonna get creative here. Sorry, give me 10 seconds. All right, that's gonna have to be good enough. It's kind of dumb, but all right. So NOI, net operating income. So your net operating income is basically as simple as your income, your gross income, or your gross potential income, and then subtract your operating expenses, right? So pretty straightforward. So at the end of the day, that is your profit before debt service and your capital expenditures. So we call this the above the line number. And what I mean by that is all your operating expenses, your taxes, your insurance, your property management, your repairs and maintenance, all that kind of stuff that goes above the line to get your eventual NOI. When you get below the line, after that, you take out your debt service. So your principal and your interest, as well as your capital expenditures. So if you have an apartment complex, every, let's say 20 years, you need to redo the parking garage, or you need to redo your massive, commercial HVAC systems, or a major, whatever, right? These big ticket items, right? You need to redo the sewer system or something like that. So that would be considered a capital expense. You put, just like you would with maintenance reserves, you put that aside every month or every year, and that goes into that. So, but that's not calculated in your NOI. So, let's see what the next thing here is. Okay, I'm gonna go back a slide really quick. So we talk about that. That doesn't matter. Okay, so we'll talk about the letter of intent in a second. But the with NOI, so let's say this is a pretty simple example. So if you have if you have $100,000 NOI, so your income is, let's say, 300,000, your gross income, and all your expenses are $200,000, right? So we have $100,000 left over. That's my NOI. And I'm trying to figure out how much this property is worth, right? So we got to figure out the cap rate, and we'll talk to you about how you can get that, figure out that cap rate a little bit later. You get that, what that cap rate is, and let's say it comes back at a 10 cap, and this is just to make numbers easy. So I divide $100,000 by, per that value formula, $100,000 by zero point 0.1 or 10% or 10 cap, and I get a valuation of $1 million. So per the market, this thing has a value of $1 million, and you can imagine that you can pretty much bet that that's what a bank is going to lend off of. So you can kind of figure out what amount of money you're going to need to bring to the table, one way, shape, or form. Okay. All right. Jesus Christ. All right. So letter of intent, similar to kind of a handshake or a gentleman's agreement, right? So it's a little bit more important than that. Um, you can see at the bottom there, it says non-binding. Sort of, it kind of depends on the state, right? You, in the state of Florida, for example, you don't need to have a written agreement to have a formal or a legal contract, right? Now, nobody's probably going to enforce that unless they were to, there's some like fraud or some other thing where somebody just kind of got shitty, right? um but anyway, it's considered typically non-binding, but what it's used to is to kind of set the tone or set the expectation for the subsequent contract and underwriting process. So I got an example here that I'm going to put out of one that we did just recently on a property we purchased. And so again, it doesn't have to look like this. You can have an attorney draft one up. We did because we're dealing with seven figure, eight figure type deals. So we want to you're dealing with a little bit more professional group, right? A crowd typically, not always, and we'll talk about that as well. But you can see, so it just what it's doing is it's saying, hey, here's who the seller is, here's who the purchaser is. See if you guys see my arrow. There's a purchaser, so us, the property itself. Here's the purchase price. And that price, again, doesn't mean we can't go back and renegotiate, but it's saying, hey, here's what it's going to be. And this is for a mobile home park. So that's where these two numbers come from. Because I told you earlier, you have the real price is right here, the 400,000 for the ground and the infrastructure. And then the homes itself are 525. So this property has 36 homes and um, 3 unit apartment complex on it. It actually has a derelict home as well, but essentially it's got 36 homes. So we gave those a value of 525. So 18 grand a piece. A lot of double wides and pretty decent shape ones. So it's actually not bad. The EMD down here, you can see. So a lot of us, ourselves included here at our company, Florida Cash, we don't put EMD down, or we put some nominal amount, $10, $100, whatever it is. Um, it's going to be difficult to get away with that in most cases, not all, with commercial, right? So there is a little bit of a mental shift, as well as you got to have a little bit of skin in the game with these guys. Now, again, you still are going to have yourself protected with exit clause, with inspection clauses, financing contingencies, things like that. Which is not what we're focusing on today, the contract, but that will be part of the commercial mastermind that we're gonna kind of reschedule here, to talk about how to write those up and make sure that they're done correctly. But you're going to probably have to have at least a little skin in the game. So doing this with zero down is still doable. You can have a partner who brings the EMD to the table in exchange for either some equity just for that, or that converts that EMD into equity in the form of a limited partner on the backside, and they basically get first right of refusal to the first round. And that's one way that we've done that before. We basically had people bring EMD to the table, and you can actually pay interest almost like a short-term hard money loan, but they would basically convert that EMD. Let's say you're buying a $10 million property and you need 150,000 EMD. Well, that's a lot of money to come up with, even if you would get it back. So you need that money so you can actually have somebody that would lend that to you, and then you can convert that into equity because they're interested in the deal, which is awesome. So you basically bought an investor for a couple grand in interest for the course of the 2 month underwriting that this takes. Okay, a couple other things. Talks about the closing date, title company, title insurance. Here's just continuing on. There's a lot of stuff in there. This one's a pretty in-depth one because there's a lot of moving parts. They don't need to be this in-depth, and it depends on the size of the loan or the size of the acquisition. But it talks about a lot of the things that are going to be in the purchase and sales agreement, right? And so that you then would take that signed LOA or LOI, excuse me, and then take that to your attorney, and they would write up the purchase and sales agreement. Um, and then it talks about the confidential. This is where the NDA and all that kind of stuff would come into play, right? Okay, so you're gonna send that LOI, and before the LOI even goes out, you may be able to get some information. And if you're gonna go to a seller, and the best way to get probably 80% of the information that you're going to need from the seller. There's other information you're going to want to go get, um, like on your own, as kind of doing some due diligence. But the stuff that you're going to get from the seller, a good chunk of it is going to be your P&L, your which is a profit and loss, your T12, which is a trailing 12, very similar to profit and loss, but it shows you trends, as well as a rent roll. right? If you can get more, if you can get bank statements and tax returns, that's great. But typically, that doesn't come till after contract. But anyway, we'll continue to define some of these things. So, what is the profit and loss or the income statement? It can be kind of called a couple of things. We typically call it a profit and loss statement. And as it says there, it's basically a seller report card, right? It says, hey, this is our income, this is our expenses, and this is our net profit, right? Now, as you'll see, especially if you're dealing with smaller properties or properties that have been held in a family for a really long time that have maybe gone up in value a lot, it doesn't matter if you're talking about a single family piece of crap in wherever USA or a big multifamily property. Never believe the seller, right? Sellers always lie; the numbers don't. So their P&L could be in fact either a lie or a not 100% of truth. Don't assume that they're intentionally lying to you. Sometimes these guys just don't know. They don't know what's going on in their business. They've got other people that are managing it, and it just they don't know. But you got to just assume that it's not accurate until you can verify, right? But anyway, that's we're going to verify that with the bank statements later. But again, typically that's not going to come till after you go to contract. And the reason is because people don't want to just give all their personal information to some Joe Schmo who has no skin in the game, right? So once you get some skin in the game, once you build that rapport, once they are confident, then they shouldn't really sign the LOI or the purchase and sales agreement unless they are confident that this is going to sell. They're going to go ahead and kind of withhold that. That's totally normal. Okay, so then you got the T12. I kind of alluded to that. So the T12, or it's sometimes called TTM in commercial or industrial, but it's trailing 12 months. But the T12 is it's a financial statement similar to the P&L, except for what it does, it breaks it out month by month instead of showing just what's the last year that you made and what's the last amount that you spent or last year's amount you spent. This is monthly. It breaks down all those same things except for it breaks it down month by month. And what that allows you to do is you'll see in a little bit, and I'll kind of show you some examples on some P&Ls that we have are personally, that it shows you trends. So you can see like, okay, everything's kind of going glides on glide slope. It's kind of keeping par with everything else, and then you got a big jump or decrease and you're wondering, okay, why is that? And that can show you some things that could be going well in the property or poorly, right? And it allows you to formulate, because of those trends you can formulate questions, and then it helps you to see things that are sometimes non-recurring. um, if a property is owned free and clear, what do you think is going to be a big non-recurring event every year? Probably around November. It's going to be taxes, right? So if you have a property that's owned free and clear, you might see a $20,000 expense in the month of November or December, whenever they pay it, or maybe October. And you're going to have to understand that that's where that's coming from. Now, it should be classified as taxes, but some companies don't have those broken out as much. So that's just one example. Okay, here's an example of a T12, right? Um, so you can see this is just a random property I picked out in somewhere. You got hundreds all the income. You got the different incomes that are up there. Don't worry so much about what all those are right now. We'll get to some of that later. And then the expenses. Different companies might classify things different ways. Some might be very, very, very detailed and breaking out. So under marketing, they might have, like, instead of just putting just straight marketing, they'll have Facebook or Zillow or rent.com, and they'll have each individual one. That's a little bit too granular in my opinion. But that's there. It's not bad to have internally, but that's probably not going to be a one that you push out. But you can see their bottom line on the income is actually pretty consistent: 106, 105, 106, 106, 107. It goes up a little bit, kind of comes down, but you can see. So let's see like this big jump in June 20 to 111. So you can see that miscellaneous right above their jump from an average of about 250, 300 up to about 3,700. So that's a great one, because what's miscellaneous? What the hell does that mean, right? Oh, right there. See, I kind of highlighted that row. All right. So what is miscellaneous? And it also jumps again in August of 20. Now, miscellaneous might be something like if you have a mobile home park and you sell a home rent to own to one of the tenants and now they had to put a big down payment. That could make sense. But if you have an apartment complex, you're not really doing that. Why do you have that, right? Where's that income coming from? Is that the months where, uh, so a lot of these low income places, they'll pay their entire rent up front potentially, or they'll pay, this could be from tenant move out. We had a bunch of tenants move out, and we kept all their security deposit. That deposit that's not on your uh, income expense line goes to income now. So that could be something like that. But we don't know. We have to figure that out. I guess I shouldn't have got ahead of myself there. Okay, rent roll. Rent roll is pretty much just that. It tells you who's in the property, when their lease is started, how long they have. It may or may not have all that, but it's going to have how much they pay for their rent, for their utilities, pet fees, delinquencies, and things like that. Where they're at in arrears as far as how much they owe or don't owe, or how much they've maybe been given as a credit, i.e., they paid, like I said, like 3-4 months in advance. Come tax time, a lot of these guys will just take their tax return and just dump it into rent. That's great. But anyway, and then the pro forma. Okay, so pro forma, right? That is basically, you're going to get these from brokers a lot. And there's nothing wrong with brokers. We deal with brokers and talk with brokers and all the time, and they're a very vital aspect to your company or to your business. However, very few of them, some are, but very few are actual investors, right? They are in and around real estate all the time. They have very detailed knowledge of the market and what it does. They're great for figuring out valuation on a park, or at least cap rates for an area, at least giving you a ballpark, right? And just like any contractor, if somebody's going to fix rewire your house, you probably got a couple bids, right? Get a couple estimates, because one guy might be crazy high, one might be low. Um, who's right, right? Well, you kind of want to figure that out. Um, but a pro forma, what that is it's defined there. That's just a Latin term, right? For the sake of form. So basically, just as a requirement, or as something nice to have, right? It's used to describe a practice or document that's provided as a courtesy or satisfies minimum requirements, conforms to a norm or doctrine, tends to be performed perfunctorily, uh, functionatorially, or is considered a formality. Hopefully, you notice where I inflected on there, and notice the difference or kind of some similarities in those definitions. So maybe I'm dating myself a little bit here, but I used to love this show. So here's the pro forma, where numbers are made up, the projections don't matter, right? So basically, take every pro forma, crumple it up, and throw it to the side. I say that sort of in jest, but I'm also kind of serious, because what they are is they're a guess. And I'll show you what the example of a pro forma is here. So that top row, where it says 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, those are years. So year one is at the end of year one, right? So sometimes they'll have what it currently is net to the left of year one, which they don't even have that here. And they're projecting year one. So it's literally a guess. It doesn't mean that it's not an accurate guess, or a well-intentioned guess, or whatever. It could be low. It could actually do way better than that, but it's still a guess based off of current glide slope. But based off of what we talked about earlier, we probably have some questions based off of the T12 and the P&L about why something is trending a certain way. So if something starts trending a different direction and we see like, hey, the last 3 months are trending down, that 1 year might be off. We have to kind of carry that glide slope through to the next year. We can't assume that it's just going to go up magically, right? Or vice versa. It's trending up for the last 3 to 6 months. What does that mean? Does that mean year one is low? Does that mean we can do more to this thing? Did we just find value there? We don't know. Are they under? Because just like sellers may overprice their properties, they could, because of a lack of knowledge, underprice, and we need to be able to attack on that, right? We need to be able to capitalize on that. But anyway, you can see this is, and you can just tell by the tenants on the side, this is a multi-tenant commercial property, like a strip mall, Anytime Fitness, Dollar Tree. This is anchored by probably a Hobby Lobby, right? Anchor tenant, the big one. And I can't get this. I can't. It won't stay. I'm like following it down. But anyway, sorry, we're having mic issues, so Tyler's laughing at my setup. Um, anyway, so you can see and you can tell that they're the anchor tenant just by the price, right? 421K is almost double everybody else, right? So it shows you kind of where they're gonna expect it to be year over year, right? And you can see most of the time you're gonna see like from year one jumps to year two, it's gonna be up a little bit. Year three is gonna be up a little bit. You can see how they're all the same. The reason for that is because most of the time these guys are in multi-year leases. Um, and you can see in year six on the Hobby Lobby, for example, it jumps up about 15K. Now, typically, most leases for these, commercial guys, they'll jump up with like a 3 to 5 or 6%, annual increase, and that's built in the lease, but not in this case, apparently. Um, and when you get these big, kind of A class, tenants and stuff, they tend to be. I don't know about Slumberland, but that sounds a little shady. But anyway, all these other ones, you're looking at they're probably paying more than they need to be in the first place, so having to increase probably doesn't make sense. But then you got look at that word potential rental income, right? So that's all potential. Be nice to have. It might be trending that way, but it might not. Anyway, so you got all these things, and then typically like go down to like effective rental income, and about $1 million or so, just almost 1,100. You got into the expense lines, right? The property taxes. Um, so let's say these people, you got this big facility, with five or I can't count, four tenants, and let's say they bought it 20, 30 years ago. Let's call it 20 years ago. So let's call about 2000. Um, and the market hadn't quite taken it was doing okay, but let's say they bought it for, $1.2 million. But now it's gone up to and their taxes have been about 70,000, for the last few years, whatever. Now they sell it and market puts the thing at it's worth 5 million or whatever, right? Let's just and I'm not using any of these actual numbers. I'm just saying now the purchase price is 5 million. If taxes were 70,000 and it was at purchase at 1.2 20 years ago, do you think that they're still going to stay 70,000 after you buy it for 5 mil? Probably not, right? The first year you might get away with it before they record it, or depending on when they record it, but after they record it, that's going to jump up probably similarly in ratio, right? So it's probably going to go up like 4 to 5 times. So you could be looking if you don't factor that in. If you just say, "Oh, it's 70 grand for taxes," that's awesome. My NOI is great. Yeah, except for in year two, it's going to be $500,000 for taxes, which is going to really kill you. Or I'm sorry, yeah, 3, 4, $500,000 for taxes. Sounds like a lot, and it is a lot, and it sucks, but that's part of doing business, right? And I'm just making that up. It would probably be it would be way less than that on here, but I'm just using it as an example. You got to keep that in mind. Okay. And then you look down here, look at cash flow before taxes, right? 16,871. 16. So for $1 million, almost 1100 or $1.1 million income, you're looking at cash flow of 16,000. And you look at, okay, why? Why is that? Why is that so stinking high? Well, if you go up two lines, this is one thing. You got the leasing commissions, right? So the way a lease works in the commercial side is they take it, the leasing agency, the brokerage, the leasing brokerage that leases up these units takes that cut up front typically. So you get it back over time, but you got to come to the table with that amount up front. So your year one cash flow is typically really low. So you got to factor that in. All right. I'm going to move on. I don't want to spend too much time on strip malls. All right. So the meat and the potatoes. What do we want to focus on, right? How to analyze your new lead, right? We want to know, okay, we get this lead that comes in. We got ABC seller that we either reached out to or called us via a direct mail campaign, or we just door knock or not door knock probably, but D for D saw it. We deep dive or deep dove him, found the LLC information, and we went and called him and got his information, right? Cool. So we got this lead comes in. How do we analyze it? Okay, so first we need to know who we're talking to, right? So as you've probably dealt with, even on the residential or small multi or even larger multi, you have different types of sellers. You have and there's two extremes and there's everybody in the middle. So the kind of left and right lateral limit. So the left extreme is going to be these mom and pop sellers, right? They've probably been in the property for a long time or owned it for a long time. In the case of our apartment complexes, but more specifically our mobile home parks, they've probably lived in the home. Like they probably lived in the park for a while. And they were it was like being in an RV park. They know all the tenants, they're friends with them, they might have raised their kids together. So you can imagine what the emotional attachment is to these. Um, and then you've got uh, just like a lot of them, there's a lot of deferred maintenance because they're probably doing all the work and they're probably doing the management and collecting. So they're probably doing a lot of cash, right? To cash stuff under the table so they don't have to pay those taxes, right? So in order to keep, that's how they're able to keep those rental rates so low. A lot of times you see really undervalued or under market rents, especially in the mobile home RV parks. You see a lot of it. It's starting to catch up, but it's still low because they take cash and they don't have to pay taxes and whatever. um, a lot of times they do the napkin financials, right? They will give you got this $1 million property, right? That should be bringing in 100K a year or whatever, 200K a year, and they don't even know what their expenses are. They don't even know what their income is. They can't tell you what it is. They have no idea how many times I've talked to these people, and they're just like, oh well, I got this one rented for this and that. It's like, okay, so what's your net, right? And you can't tell me. It's just because all they do is the money goes in to their account every month and they spend it, which takes you to the next line. They use it like a piggy bank. Um, Good example of this is I saw a deal that was pushed to me. By another wholesaler a little while ago, and I looked at it and I could tell right away. I was like, this guy is running this property into the ground. Um, and I thought it was a good property. Actually, Jaime, if you're here, hey, what's up, bro? It was actually your deal. I was looking at. Not to single him out, it's a good deal. I think if we can get it right, I think the seller is a little crazy, but this is what I'm pointing out is this is very common. Big, I think it was like 54 unit property in Texas, a sub market, right? So we're talking like not right outside of Dallas or something like that. Like pretty good property, and the guy's taking like 20 to 25K out a month just in owner distributions, which is crazy. Like that's way too much. Like he's basically drying out the tank every month, and so what that means is he's probably owned this property for a while. He's probably um, got some deferred maintenance. He's probably got some things going on with the management. He's probably doing good enough to get by, and but he's just using it as a piggy bank every month, right? So not necessarily a bad thing for you, but you just have to make sure you set the expectations for the seller that hey, you're not going to get full market for this because it's probably being undermanaged and you're not doing it right, and the numbers don't work. And I have to present this to a bank or at least another investor who's going to take this off my hands and then bring it to a bank, and they have to be able to justify where these numbers are coming from. And what you're showing me doesn't let that happen. Okay, uh, moving on really quick here. So they also typically are going to want to meet you. They're kind of leery to do business over the phone or via email because they assume the man's going to screw them, right? So you're going to have to build that rapport a little bit. But typically, like that deal Tyler mentioned in the beginning, those are where some of the biggest deals are. So our buyer, who actually both of them work in and for REI Sift and Florida Cash, are buying this property from us, and they're gonna do really well, and we're still being able to get the 6 figure deal, which is pretty awesome for everybody. But it's because of the relationship that we built with these sellers over an 18-month period to buy this thing, right? Not going to be the case with a big, kind of a big dick player, right? All right, so then you got the sophisticated investors, and everybody else is somewhere in between of these two guys. So sophisticated investors on the other side. They may have owned it for a few months. They may have owned it for 5 to 10 years. 5 to 10 years is the average kind of long-term flip for a commercial deal. But if they get into this thing and when they went under contract and when they bought it, they were able to find the stuff that we're going to show you how to find, where they can, have massive improvements in rents and decreases in expenditure. So rapidly increase and exponentially increase their income and decrease their expenses. They've done all the work right there. There's no reason why they shouldn't sell it in a few months and make a big killer profit on the backside. So, but typically it's going to be several years to up to 10 years or more. The reason they want to get out of these properties or need to get out of these properties because they have investors that are in this deal, and they're trying to continue to keep their investors' money moving. Typically after about 7 to 10 years, the IRR, the internal rate of return, tends to even out or level out, and so they want to move their investors' money into something else. Um, So that's one of the reasons. Could be coming up on a 5-year balloon or a balloon in general. A lot of commercial loans, they have those. They're not a 30-year fix like you can get on a residential property, right? They're going to be, 5-year loan amortized at 20 years or maybe 25, good case. Very rarely 30 unless you're getting into institutional debt like Fannie Freddie stuff where you got these, big, 3-4 million dollar properties and stuff. It's gone lower over the years, but big type of stuff. But these smaller ones, you're typically going to be dealing with credit unions and local banks and stuff like that. So you're going to have to get into the property in about 5 years, either renegotiate the terms of the loan, which is pretty common. And if the bank's been paid and the property looks good, they might redo it. But maybe they just want to instead of restructuring the loan, they just want to cash out and get out. They've done all the work. They've forced the appreciation. And they want to sell it. Uh, they are more professional owners in the fact that they protect themselves from liability and by holding the asset in LLC. So if you see a property that's a commercial property that's held by or deed is in a personal name, that's a good thing typically, right? We want that. We want that because those people weren't savvy enough or didn't care enough about their asset to protect it with an LLC or some other form entity structure. So it doesn't mean that the people who have an LLC have their heads on straight. Doesn't mean they haven't screwed it up. Happens all the time, but you know that they at least have an idea of what they're doing, right? Um, okay. They typically have better books, not always, but they typically have better books. They have a CPA or a bookkeeping firm, or at least somebody in the ownership that has some QuickBooks experience. A lot of times they outsource the property management, right? So they're not doing it themselves. They may be managing the managers, i.e., telling their managers what their their direction, the desired direction is, but they're not actually the ones doing it, collecting rents, things like that, and they just get reports every month. And like I said, it's simply either due to a 1031, exchanging it into doing a like kind exchange to buy a bigger property and defer those taxes after they fully depreciated the asset, typically over about 10 years, or they're trying to get their investors their money back, and then use that money to buy another one. There may be a broker involved, and don't think that just because there's a broker involved that you can't a wholesale commercial real estate or b um, buy commercial real estate at a good discount, right? Right now it's tough, I'll be honest, but we've found a couple good deals this year, and they've been with a broker. Now it was a difficult process, and it took a little longer. But what you can do, just a quick example. Let's say you have this deal, and you're like, I want to buy this, and I'm able to raise the money and everything like that. And you go through it, and you're like, I think it's good. But then, kind of as you get near the end, you find more information about the property, whatever. You realize it's not as good as I thought, but I still think it's a deal. Then you can go ahead and assign this, right? So I would be looking for an assignment or somebody to take the assignment earlier than the last minute, but you kind of have to make those decisions before your money goes hard and see if they want to take it, and they can basically transfer the EMD from you to them, right? So you can actually get your EMD back and put theirs in the escrow, right? So that's something that you can do as well. So never rule out it. Every property, even if you're 100% wanting to buy it, always plan to wholesale it. I would recommend that. Um, the most sophisticated investors out there do it all the time. So don't think that you're and I know you don't think you're low income, or low class, but don't think you're a low class dude. Like, oh, I'm just a wholesaler. Screw that, man. You're every buyer should be a wholesaler too. You should be looking to wholesale every property and then buy it if you can, right? Or if you want, and then or wholesale it if you can't. Um, and then creative financing. While I forgot to mention this on the mom and pop, you can typically, because they own the asset free and clear, or they have a lot of equity in it, you can typically or I should even say that they're in kind of a distressed property that can't qualify for a loan. You can typically get a lot more creative financing with them, either have them carry a second or carry the entire mortgage, something like that. Or JV with them, basically give them X amount of equity until you get to a certain point, and then can refinance the loan, and then you basically buy them out and have that structured in your JV agreement with them. Um, But the other thing is creative financing a lot of times isn't possible with these sophisticated investors. And it's simply due to the fact that they don't have as much equity in the property, right? They've probably already got a bank in there. They probably started at 70 to 75 or even up to 80% loan to value. And so, yeah, maybe 5 years later, they paid down some, but there's not a whole lot that they can do. And some banks just don't want to carry a second, right? Or have a second lien on there, even if they're first position they might not want a second. It's not always the case, but it can be the case. So I'm gonna take a drink real quick. Mm. Ooh, Angels Envy, man, it's great. Um, oh, that was good. All right, let's see. So the last thing there, don't let that be. Don't be discouraged by that. Right? I know you probably read ahead already, but don't be discouraged by being a new guy, not knowing anything about it, and calling somebody about their property. I'm going to give you some tools. I'm available. I'm going to give you my personal information when I get off this phone. Don't send nudie pictures to it, but you can call me anytime. You can text me. You can email me about any type of questions you have. I've got quite a bit of experience. I've got partners with over six figures in their education in commercial real estate. I've got mentors, and I'm not saying this to brag, but I've got mentors that have mentored me and my partners with decades of experience and hundreds of millions of dollars in sales and acquisitions. So if I don't have the answer, which I don't have all the answers, I can get it for you. I can at least help you and maybe put you in the right direction to get the deal funded or get it closed, right? So I'm here for you. The commercial real estate realm. I know I'm going off topic here a little bit right now, but the commercial realm is much more different than the single family in that you can do most single family deals on your own. It is very difficult and in some cases impossible to do a commercial real estate deal, especially big ones on your own. I mean, it's just very difficult. And even if you could do it on your own, it makes a lot more sense to do it with a team, right? Um, so it's the best use of your time, right? We got to think about not only not can I do it, but should I do it, right? Anyway, so what I mean there is they can smell a newbie, and this sounds kind of harsh, but what I mean is they're gonna want it when you get on the phone, right? They're gonna want you to ask what you need, and they'll give it to you, or they won't, and they're gonna tell you what they want and what they need. And from that point, it's a lot easier. It's actually easier to deal with sophisticated investors because it's just black and white. There's a lot less emotions and that's one nice thing about commercial versus residential, at least when you're dealing with sophisticated people, is that it's not emotional. There are sometimes there can be issues when somebody realizes that their property isn't worth as much as they thought, or some big ticket item pops up, like a big infrastructure issue or a zoning issue. But that's because they realize that they screwed up more than they're emotionally attached to the property. So that's actually really nice. It's black and white. It's worth this or it's not worth this. Okay. So now we've covered what the different kinds of sellers are. Let's talk about how to talk to them. So yeah, when you guys should be good at mom and pop people, right? Because you're used to doing it all the time with single family on the commercial side. So get in there, build some rapport. If you're cold calling them, they're gonna have that kind of awkward, "Hey, how's it going, man?" Type of thing. But a lot of times you can just have a conversation. You start talking about, if you're a military dude, a lot of times these guys are, especially in the mobile home and RV park or even the apartment complexes, they've owned real estate for a long time and they were, military dudes before World War II, Vietnam vets. We just purchased a storage facility from a guy who's a retired full bird colonel in the Marine Corps, Vietnam grunt. He's got, silver stars and purple hearts and everything you can imagine. I mean, slaying bodies. That was his living, right? So it's super easy as a Marine, as a Cobra pilot for me to build rapport with them. You guys find your own way to build rapport the same way you've been doing it with single family, and you'll be fine with these guys, right? So once you do that, then you got to, you kind of got to get some questions answered, right? So, but before that, build that rapport. So you don't be in a rush. They tend to be emotional. Try and avoid talking about the property a little bit until you kind of get to know them and they get to know you, right? And then you can kind of start asking about the property and you kind of say it like, oh man, that's great. This is good, stuff like that. And at the end of the day, just like we do and this is mom and pop and sophisticated people, just like single family. Why are they selling? We need to know, we need to understand the why, because just because of our preconceived notions that we say, okay, these guys are probably just selling it because they are looking to invest in something else. What happens if they're a sophisticated investor and they're coming up on a foreclosure and you don't know about it, right? Or they're coming up on that balloon and you don't know about it, right? So they could have their backs up to a wall and they might be much more inclined to make decisions or make deals, you know, because of their situation, because they don't really give a shit about yours. That you have to figure out what their situation is, right? And then the sophisticated investors still build rapport, right? This is a business transaction. We're in the business of people, so there's still people involved, but expect to get down to business a lot more quickly. Good news is they're pretty much going to be able to talk about their business much better than mom and pop. They're probably going to have the numbers. They're going to know how much rent is. They're going to know who the manager is. They're going to know who to talk to. They're going to know where to get the information if they don't have it readily available. They probably have their reports, their financial reports on a document, or at least easily accessible via a drive or via a website that they can just quick download it, send it to you if you need it. And they're like, yeah, sure to do, no problem. Much easier to deal with them, and uh, much more enjoyable to deal with a lot of times in the mom and pop as far as the financials. Building financials is not that cool. Um, you see that bottom a couple things there. It's, don't expect to get the actuals on the first call. And what I mean by that is it's not that they're withholding it, but again, they don't want to lock up their property because they understand that a commercial deal can take months to close. So if they're looking to sell and they want to know that you're going to buy, because they know that once you lock it up, it's going to be a couple months before they can even resell, get it under contract with somebody else. So they want to make sure that they know who you are. They want to make sure that you're going to call them back and follow up with those financials. So don't be surprised if you get in the financials that you don't even have, that you might have to go through a kind of the gatekeeper, right? You might have to go through one of their brokers or their CPA or their COO or whatever, the CFO, to get information, especially if they're bigger players. So don't be surprised. NDAs, they're normal, completely normal. Don't be afraid of them. Sign them. It's not a big deal, but honor them. Don't screw that up. Uh, Make sure that people sign NDAs if you're giving that information out, and make sure that you trust the recipient of that email. Don't just willy nilly do that. That kind of bothers me when I see people just throwing out there, just had to sign this NDA, and now they're pushing out this deal, and they've got 30, 40 people with an NDA out there. It's like, well, do you even know who they are, right? I want to have a conversation before I'm sending somebody out an NDA. Okay, so let's get in the meat and potatoes. So I spent a little bit of time talking about how we can, identify these properties, what they are, and how to talk to some of the sellers. Hopefully, I haven't lost you. Here's where it gets fun, guys. All right, so we're gonna break this down asset by asset, right? So we got mobile home parks, we got mobile home slash RV parks, we got storage facilities, we got apartment complexes, we've got office spaces, and they're all exactly the same as far as how we evaluate them, right? Of course not, right? So let's start with mobile home parks slash RV parks. And we know there's a big difference between like a mobile home park and like a Koa or a Yogi Bear or like a nice, beachfront RV park, right? Doesn't mean that the mobile home parks are nasty. Some are for sure. I think I own about 90% of them, right? No, just kidding. I wish. But anyway, the RV parks, there are long term and there are short term. I'm going to focus here mostly on the long term. So when I say mobile home or RV, I'm kind of interchanging them. Okay. Because when you get into the recreational RV parks, which I think are great investments, especially right now, especially in Florida, you have to treat them like a motel slash hotel, right? We're looking at a mobile home slash RV park with long term as an apartment on wheels, and we're looking at the recreational, vacation RV parks as like a motel slash hotel on wheels, right? They're going to come in for a few days, a week, they're going to leave. They might stay for a month. Snowbirds might come in for several months, but it's run a little differently. So you have to kind of take averages and you have to break those out by month. That's way more than we need to get into right here. So when we're talking about a mobile home RV park, these are like, if you have this information right here, you can make 95% of the valuation, assuming it's accurate. Again, you need to verify it, but you can pretty much figure out about what it is worth with this information right here. So you want to know how many units, right? So there's a difference between units and spaces. So somebody says, I got this 100 space RV park or mobile home park for, I'm going to sign it or I'm going to sell it. And you're like, sweet, dude, 100 units is awesome. except for it has 15 actual units on the property, right? And it's because it was under managed or it's in Illinois. Sorry if you live in Illinois, I'm from there. Where these parks can be in really bad shape or just whatever reason. But you want to know how many spaces you want to know, and you want to know how many units are actually there. So that POH versus TOH. Some of you guys might already know this, but POH is park owned home versus tenant owned homes. So the difference between mobile homes and RV parks and apartments or large multifamily properties is that you have the infrastructure and the land at the mobile home park, and you have the uh, chattel or the personal property, which is the home itself. It's called chattel or chattel. Sorry, getting my French accent in here. Chattel. So this chattel is what they actually occupy, but the where they're actually at is the ground. What they're actually leasing is the ground. So if it's a park-owned home, that means that you own the lot, all the land, and the infrastructure, and the home itself, as well as all the maintenance and repairs associated with that. Taxes on for the title and tags. If it's a tenant-owned home, they own the home, right? So they own the home, and they are responsible for paying you to lease their land, kind of like a parking lot, right, or a parking garage. Um, so that is important. So the reason it is important is because when you go to a bank, the way they'll typically evaluate a mobile home park slash long term RV park is they will take the lot rent for the average lot rent. So let's say you're at $300 a month lot rent and $600 to rent a home, which is the lot rent plus the home rental. So you got $300 spread, right? Sounds like, okay, why wouldn't I rent these all out, make double my income? Okay, yeah, maybe I got some expenses. Well, the way it's valued is a bank will look at the lot rent income. And I'm going to write this up on the board here in a little bit once we get done here, answer some questions. But they'll look at the lot rent and they'll capitalize that, meaning they'll divide they'll use that NOI or that valuation formula. Value equals NOI divided by the cap rate. But they'll only use the lot rent to determine that. So they'll take the lot rent. Let's say you have 100 units, $300 a month. So that's $300,000, or excuse me, $30,000 a month times 12 months is $360,000 a year is my gross income or gross potential. Let's say I've got just to make it easy, a 50% expense ratio. And so that puts me at what, $180,000 NOI. And it's at a 10 cap. So that would mean I divide by 0.1 and I get a $1.8 million valuation for the park and the lot rent that it can generate. But you say, okay, but I've got, let's say if of those 100 units, 50 of them are park owned homes, meaning I'm making actually 600 for 50 of them and 300 or 300 for only half. Well, what they'll do is they'll take those 50 homes and they'll assign them a value based off the age. So let's say an 80s unit is 3 grand, a 90s unit is 7 grand, and a 2000s to 2010 unit is 15 grand. And so they'll add those up and then they'll add that total gross value on top. So let's say that the total value of all those homes, if you were to sell them all off, or what they assign to, it's a wholesale amount. I mean, you could probably get more for them. It is another 200,000. So we're at $1.8 million, and you add 200,000 for the 30 homes. Now you're at a $2 million valuation. So that's how they do it. What happens a lot of times is you'll see not only sellers understandably want to capitalize everything, but brokers will capitalize that. So instead of, and just without going back through the math again, instead of having a $2 million valuation, because they take and capitalize the entire $300 above lot rent for those park owned homes, they'll have a valuation of like $3 million, and which is obviously huge difference. But a bank isn't going to lend on that. And so, how are you going to explain that to a seller whose broker told them that it was $3 million property because you can capitalize this, that, and the other? Well, that's going to be your job to take that information that I just told you about and show them the math and be like, this is how we have to value the property because this is what a bank's going to do. Right. And anyway, so that's that. So single versus double wide. So for example, we have properties where our single wide lot rent is 350. You're not going to get double lot rent for double your, double wide, right? So you're probably going to get 100, maybe a 25 to 30%, maybe pushing 35% increase, using, a double wide. So for example, we have 350 in our mobile home parks up in Indiana for our single wides, and we charge 450 for the double wide. It's just not going to have, it's not going to work to charge them double. Um, okay. The ages of the homes, I already kind of alluded to that. If they're tenant owned, you don't care as long as they're presentable and they look okay or can be brought up to code if there's any code violation issues. But for the park owned homes, we want to know that because anything built prior to 1976 was pre HUD, so they had much lower construction requirements. Anything post HUD is definitely gonna be better. But again, a 30, 40, even look at, we're in the 80s, man. That's going on a 45-year-old home. Um, they're not designed to last forever, contrary to popular belief, right? Or what the tenants or the owners believe. And a lot of times, because they've owned these for so long, these things are at the end of their service life. So you have to see how much they're going to last. And that's going to lead you into, do I fix it? Do I replace it with another home? Or do I go to RVs and drop an RV in place? That RV is the easiest and best option in all cases to me, uh, but you have to comply with local zoning and density regulations. So not all cities and many won't allow you to put an RV in the place of a mobile home without rezoning the property. Again, that's something I can talk to you guys offline. I'm not going to get into all that right now, but that's very important to understand. The utility source. Okay. So is it private or public? Is it on sewer? Is it on septic? Is it public, city water, city sewer? What's the pipe construction? So again, these parks have been built since the 50s. So they can have clay, they can have PVC, they can have cast iron, all galvanized, all these different kinds of stuff. And a lot of times it's all of the above, right? So we've got, lots of different things that are Frankenstein together, which it could obviously be very bad, right? Um, and you also want to kind of know the life cycle or the lifespan of these things. Like, for example, clay would last, maybe 30 years or 50 years before it's bad. If it hasn't been replaced and we're at 35, 40 years, we're sitting on a ticking time bomb for a, you know, quarter to $500,000 infrastructure repair or more, depending on the size of your asset. So that's something to definitely consider. There's actually this stuff, and I can't remember what it's called. It's called orange something, but it's these pipes that they use to save money back in the day, and it's literally sewer lines that are made with paper. It's just paper pressed together, and you can imagine how well that does with constant water and crap. No pun intended going through it. Okay, you want to know who of those utilities who pays them, because this is one of your biggest and what we found to be our biggest upside potentials. So a lot of the properties we take over ownership of, the tenants don't pay a lot of the utilities, either because it's not in their lease or because they just don't pay. And so what we do is, for example, we have a park, our first big park we had in Gary, Indiana. We ended up finding during our underwriting that while it was in the lease that the tenants paid the water, the management company was not paying, having them pay for it to the tune of about $75,000. Now, the great thing about commercial real estate, take that formula, right? So it's not just, okay, I didn't just add $75,000 to my value of that property by billing that back. No, you have to divide that by the cap rate. So, for example, in this case, take $75,000 and divide that by 0.12. And that's your number that we added to the park because it's about a 12 cap. It was trading at a 12 cap. It's trading at about a 9 cap now, which is awesome. So, but even at a 10 cap, that's $750,000 that we found. And we had to do no work. All that we had to do was change the lease and actually implement and enforce the rules of you pay for water. Now, there are sub meters on the homes. And if they don't have sub meters, that's something you can put in. Um, but they were there. We just had to get a new fob. They weren't The fob died, the little electric fob that they go up and to read the meter, and the management company was too lazy to go get a new one, and they were costing their owners almost $750,000, right? A little bit over, which is just crazy. So it doesn't happen on everyone, but there's always money to be found. Okay. Utilities for like usage as far as water, electric, sewer, trash, things like that. But then there's like the actual infrastructure. What does the park own? And do they own? So one thing we found is that we thought, because our parks in Florida, um, you didn't have to, like, we don't own the power lines and the power poles. That's not the case up in Gary, Indiana, where we own the poles and the lights and everything inside of the property line of that park. While they have a utility easement, and that's why we made the assumption, which, you know what they say about assumptions, uh, is we got caught kind of with our pants down when we had a tornado go through the area. Thankfully, not our park. I know it's pretty cliche to have a tornado in a trailer park. But anyway, it took down about $20,000 worth of utilities. And we thought that, hey, you know, the utility company would pay for it. They weren't. We said, okay, that's fine. We'll just go file an insurance claim. Well, because we didn't think that we owned them, we didn't actually have utility coverage in our insurance policy. So guess what we had to do? We had to pay it out of pocket, which is unfortunate, but you know, it worked out in the end, and we learned, and we, you know, changed our insurance policy. Um, anyway, so that's the kind of things you need to think about, not only in purchasing, but also in figuring out for insurance when you actually buy the property. I need to make sure I have this coverage, not just how much money can I save, but how much can I protect myself against. And that's one thing, as well as, oh yeah, my insurance is just $1,500 a month. Yeah, but that's literally just like bare bones, covers you against nothing. It's probably going to be 5,000 for insurance because we went and got quotes, and this is all the things that we need to be covered against. Whatever you want to be covered against is fine, but whatever we need to be covered against is this. And I guarantee you, everybody else that's a professional is going to, you know, get the same type of insurance. So that's a cost. And when you capitalize that, again, remember every dollar. So in this example, every dollar that you save that you either find or you reduce is like eight, nine, $10 worth of value. So if you find $1,000, okay, that's pretty cool. It's pretty dope on a, you know, assignment, you know, here, you know, for a single family home. You find $1,000 in a commercial property, you just added $10,000 on a 10 cap. And most properties nowadays are an 8 cap or less. And so you're really saving like 12 to 15K for every $1,000, which is just amazing, right? Um, and that's the true value and the true power of commercial real estate. Okay, the on-site manager. This is going to be in the case of mobile home parks, RV parks, and potentially apartment complexes. So a lot of times they'll have a management company, a professional company that's a third party, and they live off-site. They probably have multiple. You're not their only client, and they manage the property. They give you the reports. They collect. You know, they do collections. They handle evictions and all that stuff. They schedule maintenance. That's great. A lot of times, especially in RV park, mobile home parks, more so than anything, is because a lot of professional third party management companies don't want to touch them, whether they have it's justified, they've been burned in the past, or just they have a negative connotation against mobile home parks. So you might have to find somebody in the park to act like a camp mom and basically enforce the rules and collect the rents. And a lot of times, what you'll do is you'll give them a rent concession. You'll give them free rent, and then you'll give them like a nominal amount, like 15 to 20 bucks per home per month for manager, or maybe 10 bucks a month for management for homes. So if they have 100 homes in there and they collect the rents, they get $1,000, right? And they get free rent. So if it, you know, lot rent is 500 or 300, 400 bucks a month, they were getting 13 to $1,400 a month to do that, which is for these people is a lot of money. Um, okay, now let's move on to apartment complexes, right? So this is kind of like everybody's like, I want to buy these apartment complexes. This is, you know, this is commercial real estate, and they're right, but it's not. As you've hopefully seen, this is not the only one. So some of the things I'm gonna kind of fly through some of these. You want to know the unit breakdown. So how many beds and bath per? So if you've got 10 2 bedrooms, 10 1 bedrooms, and 10 3 bedrooms, those are all going to be valued differently, and you need to call around and figure out what the local market rents are for those, and then combine those and compare those to what the actual property is collecting, right? Okay, so are they Section 8? Are there any HUD type of things? You know, stuff like that. What's the age of the big things? The age of the roof, the mechanicals, HVAC, stuff like that. You know, you see that tuck pointing. That's like the little crap in between the bricks. What's the schedule been done on that? Is there coin laundry? You know, all that kind of stuff. Are there amenities, pools, gym, dog park? Those add value to a property in the eye of a bank, but they can also increase your liability, right? You got a park, a gym, anywhere, any place, any common area where somebody could get hurt increases your liability. So you got to cover yourself for that. Okay, storage facilities. Uh, these are rapidly becoming one of my favorites. Um, so that's why I said if you have any, send them my way, especially if they're about 50 to 100 units or more. So you got the different sizes, right? You got 10 by 20s, 10 by 10s, 10 by 30s, 5 by 10s, by 15s, whatever. And you got, parking, like exterior parking or outside parking, RV boat. You got covered parking, and you've got, um, conditioned space, right? Where people want to store stuff. So you need to figure, so storage facilities are valued on their price per square foot rent, right? So the smaller a property is, the higher the price per square foot is. Now the total gross amount they generate is going to be less than a 5 by 10 is going to generate a higher price per square foot, but it's going to be way less than a 10 by 30 rental, if that makes sense. Um, and so you got to take that entire amount. So on storage facilities, you just take the entire amount of income, divide it by, or subtract the expenses, and then divide it by the cap in the area. But there are some other things. Security is a 24/7. That accessibility is going to increase the value. Does it have lights? Does it have gates? Does it have high fences? All that kind of stuff. Locks, the proper locks, things like that. Is there on-site management or no? Things like that. What's the condition of the parking lot? Stuff like that. Um, do they have extra contracts? Do they have contracts with U-Haul, to which that draws a lot of people in to move their stuff? Right, they come in to bring a lot of stuff in to move their stuff, and then they end up bringing their stuff to the facility. What's up?
You check like questions and all this?
No, do I need to? Sorry,
Yeah, you might.
it's hard to.
I
Yeah.
would just do like a don't stop screen sharing.
Okay.
You could just do like an escape.
Sorry, guys. I get talking.
So, so you can click here and show, and then kind of like answer the questions as.
Okay.
And
Yeah, we're gonna be here longer than 5, guys. I'm good with it if you guys are. So, um, I'm trying to drop as much content as I could. All right, let's see. Nice wholesale 10 fit 5 unit. Nice. Can the volume go up? Just okay. I got that. Sorry, I'm reading through. I'm catching up, guys. Yeah, exactly. Reading Sean's comment about the LOI. Yep, 100%. Um, I'm gonna get to D for D, Claudio. I'll get there. Uh, wants to sell her home and the 5 apartments she owns around it. And when I asked her for rent rolls, I said, "What is that?" Okay, so oh, that one. Okay, there you go. Oh, that's fancy, man. So Dylan, good question. Um, yep. So I'm pretty sure I covered that and I talked about how that the napkin financials and stuff like that. Um, what's an LOIS? You got to remember these people. This is like a military guy talking to a civilian. They don't. It's a whole nother language. I'm gonna break your shit here. It's a whole nother language to them. So you might just have to you have to build and understand who you're talking to and kind of go to their level, right? So if you want a P&L and you realize that you're talking to grandma who's owned this property or maybe even inherited it, you're going to have to say, hey, how much money, what are you bringing in each month, and what are your expenses? Like, what are you spending your money on? Something as simple as that. And you'll just have to break that out a little bit. So you're going to probably have to, as much as I talk crap about the P&L, that's what a bank wants to see too. So they're gonna want to see the actuals and stuff. But if you have that quote unquote napkin financials, they're gonna want to see that you've at least accounted for all these income expenses, and you're going to have to explain that in your business plan to a bank or to an investor that you're wholesaling this deal to, right? Because you can't verify it. There's certain things if they're taking cash, she could be completely lying, right? But you have to kind of take into account what you anticipate and what you can assume. Um, and then you would create a P&L and L and say, okay, this is what I think it's doing, this property is doing. And again, when I say the bank and your buyer or the person you're assigning it to, or your investors or JV partner, they're all interchangeable. The person who is a professional that's going to somehow allow you to complete the deal, and put it that way. um, Probably a question for later, but how do you comp a commercially zoned lot?
Depends on what you want to do with it, right? That's a really hard question. That's going to be a broker question. I would call a broker in the area and say, hey, I got this lot, and I'm looking to see what we call it the highest and best use. So that's the big thing. So you have to look at the local zoning, which you can find and just go to the zoning and planning department. You can give them a call and you can say so you go into the records, right, county records, whatever it is, and it'll say zone C2, whatever. Every zoning area is a little different, and you can go into the zoning books and you can literally say C2 equals can be zoned for light commercial up to X amount of units, can be zoned for mobile home parks, RV parks, or storage, or not to include blah blah blah, and it'll just tell you right there. Sometimes though it's a little vague. They'll say it, you're like, ooh, are they saying I can or I can't? So you just call the zoning and planning department, and there's a little more. So you got to in residential stuff, well, you got to dig with the seller and maybe a little bit with title. But when you're dealing with commercial, you got to dig with the seller. You got to dig with the county a lot more, and brokers and banks, and you have to dig in, and you're going to be calling a lot more people. It's going to be a much more time intensive. You don't just get 600 or a six figure deal for doing no work, right? There's the unicorns, but you're going to work for that shit, right? But what I would say is call a broker, call the zoning. First of all, call it to sound, make sure you know your shit. Talk to the zoning department or planning and zoning. Figure out what the highest and best use is. Um, you can go a step further and figure out what's the kind of the planning, like what's their plan. I'm blanking on the term for it, but what they're calling it, but basically what's their flow, where are things trending in that area, what do they want it to do, because whatever the county wants the area to do, they're going to incentivize that, right?
It's like and you guys might not be able to hear me very well, but a good example on that is we had a deal that wasn't too far from where I lived, and I looked at the land like it was nothing. You know what I mean? It was like, oh, just another piece of land, and like 6 months later, a Culver's is being built there. It's like, you really sometimes just don't know, because it takes the right investor coming in to want to do the certain thing that is. I mean, there's a lot that's been sitting for years down the street from me, and now there's a massive 3-story um, storage facility being built because a REIT found the land and wanted to build it. How that happened, what REIT it was, who knows, right? But you just in commercial, being that most people start off in single family, you need to be able to think not as a single family individual. You got to be able to think of like, what could it be, or what could I, as an entrepreneur, turn it into? I wish I would have thought that I could have opened a Culver's, right? I wish I would have thought that hey, I have the net worth. What is the food chain? What is the Dunkin' Donuts or whatever? Just down the street from our office right here, there's a three unit commercial building that was built right on the corner. It has a Dunkin' Donuts, a Wendy's, and then a T-Mobile in it. It's like, why am I not doing stuff like that? Why can I not see the vision of the need in my market? Who do I need to network with, and what needs to be done? Because that's where you miss out on the most opportunity, is thinking about what your market needs. And the best way to do that is not really knowing the value of the land. It's knowing, like Jake said, what is the county trying to push? What is it that they want? What is their agenda to turn this city into something different, right? So making sure that you're part of your chamber of commerce is probably one of the biggest things that you can do to have an impact in knowing that kind of information, because that's where this shit's talked about. All right. Cool.
What else you got? Who is doing the present? Oh, me. Oh.
Presentation, or
Yeah. Is that salsa or queso? I'll take some queso if that's what it is. I don't know.
this is so valuable.
Yeah.
Cool.
Yeah. Thank you. Okay. Let's see. Good. I like this one. Hey man, awesome. I'll be here. Traffic is terrible here, so if you don't leave by 3, you might as well not leave till like 7. So whatever. Uh, yeah. Thank you. Future land use map. I'm retarded. That was what I was looking for. You can get that from talking to your county, and it's actually good to go in. I know we've had a lot of counties. Thankfully, Florida is still the land of freedom, but a lot of counties it's been difficult to get with them. They're doing a lot of teleworking. You can't go in, but having a face to put with a name, both them as well as you and somebody to talk to,
put a lot of times when you go in, like especially here, I'll use Santa Rosa County for example. You go in and there's a list of, or like a little thing full of all their different department heads, cards. Take all those cards, store them in your phone, and give them a call when you need it. And that's a good great way, and get to know them by first name and stuff like that. Go to the planning and zoning, the variance meetings, and learn and figure out what's getting approved and what's getting denied. It's time intensive and it's tedious, but it's not just for wholesale, like doing one deal. Like this is for you as your wholesaling businesses or whatever, however you are structuring your real estate business. When this starts to take off, that is how you grow. Like that is how you get that exponential growth. Like flipping and wholesaling, that's great. It's a great way to get that cash. It's I don't think that it's most people's end game forever and ever and ever. It's definitely not ours. I mean, we use it as a way to fund our long term holds, or to provide relationships or opportunities for us to then go into more big deals. And we're starting to make those moves, or we've been making those moves in certain areas and things like that. And that is the only way you can do that is by getting out in the community more, right? And we are no different than you guys. We need to do a better job of it. Even if you're doing it a lot, like there's always something else you can do. That's really the best way to get good at doing commercial real estate, is be that guy that everybody knows, and when they have something come up, they give you a call, right? So that's a good way. What else we got? That's it. All right. Keep throwing those questions. I'll come back periodically, guys. I may need Tyler's help. I'm kind of a tech dummy. Okay, so I think I covered everything on the storage facility. The on-site management thing is actually, so this storage facility that we bought was owned by the tenants, or the owners next door. So it was their lot, and then they had their parcel next door was a 3 acre storage facility. And every morning at 5 o'clock, the owner would get up and go and raise the Marine Corps flag, and then he'd go and open up the property, and then at 7 o'clock every night he'd close it. Now, probably 90% of the time, you're not going to have anybody come in between the hours of 7 and 5 in the morning, but 7 at night and 5 in the morning, but you might. And that's a great, when you figure in that when people come and store their stuff in a storage facility or sign up or looking for storage, they're going to put their stuff there, and they're probably statistically, they're not going to come back until they move it out. There's very few people that come back until they're ready to move it out. The average stay is 7 months. The average price per square foot per month is 63 to 64 cents a month nationwide. Obviously, bigger cities are going to command a lot more. Smaller cities, a little bit more rural areas, a little bit less, but that's the average. So if you've got 12,000 square foot, and 10% of your tenants come from those hours just throughout the year, and you have the ability to leave that thing open for 24/7. Not only is the gate automatic and you have it coded correctly, coded right, and everybody gets their own access code, things like that, kind of like an Airbnb with the Wi-Fi remotes, or the locks. They can come in anytime, and it's just convenient, right? We pay for convenience. Even 10% at 1,200 square foot there, I mean, at 63 cents a month, we're talking, if you get 10% of your revenue from those hours, you're talking at whatever that is, probably, what is that? I can't do math, like 800 to $1,000 a month that you're getting just from that, right? And so you factor that in over the course of a year at at 10 to 12,000, and then you divide that by the cap rate, which for our storage facility is about 7 cap. So you divide that by 0.07, you're talking about tens of thousands of dollars, right? And then a 12,000 square foot facility is small. You're talking 30, 40, 50 plus thousand square feet, which is kind of where we're going to be, where your wheelhouse is going to be, because once you get above that 50,000 mark, you can do it, but that's where the REITs start getting involved, and that becomes difficult to compete with them, right? So you want to find your niche, just like we do with your lists and everything with REI SIP. You want to find your niche. Market, right? You don't want to compete with the big money. Like you just can't. You can't compete with people who can buy at a 3 cap and a 4 cap, and they're literally just buying it for depreciation and like a couple percent a month, for their investors, right? You can't compete with that. You don't want to. Okay. Next. All right. So office space. Okay. So like I said, we bought an office. We bought a very unique office because it's 5,000 square feet. It's 2,500 downstairs, 2,500 upstairs, plus or minus. And the bottom has got a left and right office. Very, very normal. Office on the left, office on the right. Set up, well for space. Got some for office use. It's got some bathrooms. One side actually has a kitchen, which is pretty cool. But that's pretty normal. The upstairs was built by the original owner to be lived in and have his construction company downstairs. So we have residential. So when you come in and you look at that, um, that can be difficult to kind of determine what to do with that. So in an area that's pretty close to the beach, what do you think we did? Well, we turned it into an Airbnb, right? We set up each individual room as its own rental. So we've got 5 Airbnb units upstairs and a shared kitchen, a couple kitchens. We've got several bathrooms up there, and then we've got like a rec room area. And so excuse me, that's what we use. That's what we converted that into to basically stick with that commercial model. So we've got um, commercial office space, and then we've got kind of commercial multifamily, so to speak, upstairs. So that's kind of that hybrid. But on the office space in general, you're going off of rentable square feet, right? Because the way that commercial real estate is valued or office space is priced or rented is priced per square foot. So in the Fort Walton Beach market, the average is about $13 a square foot in our area of Fort Walton. It can get as high as about $15 a square foot or whatever. Now that's not monthly, that's annually. So let's just to make it easy, it's $10 a square foot, and you've got 1,000 square foot office. So that's obviously $10,000. That's over the course of a year, and it's broken up monthly. So you're at $833 a month. I think that's the right math for that office. And if you got 10 of those, you multiply it times 10, you can, and then the nice thing about commercial office and commercial real estate in general and is that you can pretty much do whatever you want as long as both parties agree to it and it's in compliance with local zoning and regulations and code. So if you go in there and you say, "Hey, I'm going to, charge maybe the market is $12 a square foot." But what you do is you say, "Hey, I'll give it to you for $10 a square foot." And you handle your percentage. Say there's 10 units and they're all the same size. Very uncommon, but let's just say they are. So they take 1/10 of the taxes, 1/10 of the insurance, right? So they pay for like a total insurance. They're going to have their own company liability, like for if they're doing salons, they don't want to give somebody some, head disease. They're going to have like a liability there. But I'm talking about the hazard insurance for the building itself, and you can actually break that out as well as the CAM. So I do have it in there. Item D, CAM is common area maintenance. So let's say there's landscaping, there's sidewalks that need to be shoveled if you're up in the north, or there's like a foyer area or a community kitchen, and that needs to be cleaned and maintained or repaired, whatever. That's all broken out over the course of a month, and they pay for that. So we've essentially turned that from kind of essentially a multi-family office space into a multi-family triple net lease where they pay everything. And so if they pay me $10 a square foot, and we said that was $833 a month, and then we have 10 of those, we're getting $8,333 a month, and that's it. That's all. We have no expenses. Our taxes are paid for, our insurance is paid for, our maintenance and everything is paid for. We just paid taxes at the end of the year or whatever to the tax man for rental income. And when you factor in the depreciation that we're probably going to get, we're not going to pay a whole lot. So that's the way to do it, in my opinion. It's kind of like converting a park-owned home into a tenant-owned home. I'm going to want to convert, and that's a great value add. I'm going to want to convert that park-owned home into a tenant-owned home using a rent-to-own or a lease option, whatever, right? Or just a straight sale. Hey, I'm gonna sell this thing for 10 grand to you. You're gonna take it or you're gonna leave, right? And if they decide not to take it, that's fine. Then they move out. You fix up the home a little bit, you sell it to somebody and do that. So, but anyway, you're gonna want to know. Sorry, back to office space. You're gonna want to know how many units there are, how many square feet per. Again, it's probably not gonna be equal. You're gonna probably a bunch of different things. Um, so a big unit, like think about these strip malls, right? And so they've got these, like a Subway and I don't know, a GameStop, They got whatever, a hair salon, whatever, like a little sports store, like a mom and pop one, and then you've got like a restaurant, like a bigger restaurant, like a I don't know, Arby's or a Pizza Hut, and then you've got a big store like a Big Lots or something like that, or a Target, and probably not Target, but you know what I'm saying, like big name, big box store. So that big box store, the biggest one is going to be called your anchor tenant. So that's great because they can pretty much cover. They're going to be probably closer to that triple net, right? If they're and almost guaranteed they will. But the big thing you have to consider is when is their lease coming up, right? What is their, and it goes back to that, what is the county and the community, what is that future land use plan? Is the area increasing? Is it decreasing? Are we seeing a growth in the community, or see a decline? Because if that anchor tenant goes, it's highly probable that that deal is a complete turd, right? So we have a place in Milton, in my hometown, right down the street, literally across from where I used to live. Had a Big Lots, had a Beals or Bell's, and had a couple other places, and then smaller places like a UPS store, a Subway, a Chinese restaurant, stuff like that. And the Bells went out of business there. They're not there, and they were definitely the anchor tenant. The Big Lots is, I think, wrapping up as well. So they lost two anchor tenants there, and that place is essentially dead. There is like it is a probably 2,000 car parking lot, and there's at best 20, 30 there at any given time. So you can imagine how that's affecting their cash flow and the value of that property. Um, so when you have big tenants, you have a tendency to have long leases, but you have a long vacancy probability if and when they leave. The flip side is if you have a lot of smaller ones, you're going to have a lot. It's going to be a lot easier to turn those and to occupy those, but the rents are probably going to be less per square foot, and you're probably going to have a hard time to convert those to triple net. They probably, like I mentioned, that example where they're 1,000 square foot a piece, it's unlikely you're probably gonna have expenses and repairs and stuff like that. And you charge more for it. You're gonna account for that, your expenses in your rent, but you also have to remember you're competing with the market. They can just go somewhere else. That's the other thing. You're gonna probably have higher turnover, but you can fill them up. So you got to consider all that. How much parking is there, right? And then we already talked about the other things. Tenant improvement allowance, that's basically just that the landlord will pay, give them a certain amount to fix their place up to do something. So if you had a hair salon in there, for example, and a Subway comes in, that's obviously a very different looking uh, you know uh, shop. So they're going to probably need $50,000 to get that thing up and running, probably more, but let's say it's 50,000, and you might give them a $20,000 allowance or more or less because you want them in there because it's going to draw, you know, more people there, and it's going to increase your value, right? So that might be something you can do. All right, so we've already kind of covered, or at least alluded to some of this stuff. I'm going to come back really quick. Exit full screen. I'm going to see if we got any other questions. Uh-oh. There we go. We got any other questions real quick? Okay, nope, we don't. Perfect. I'm going to keep going. Sorry. Okay. All right. So finding the blood. When we say find the blood, that's the finding the money in the deal, right? So we're looking at the financials that we were given, the profit and loss, the T12, the rent roll, and potentially the pro forma, and we're going to find what we think, or we're going to find where they're underperforming, right? Or maybe fudging the numbers a little bit. Okay. So this is a profit and loss statement. This is actually for a mobile home park that we have up in Gary, Indiana. And so this is using a system. This particular one is used Rent Manager, which you got Rent Manager, you got Arion, or you got Buildium, Yardi, a couple other different ones. You also have the standard QuickBooks, and they're very similar, but it's just there's a little bit of difference. But this is going to look very similar, but it could be different some of the numbers, and where their things are at based off the system that that company uses. And so you can see they're all coded out, and you've got that rental income, right, which is 185,000, right, and then you've got other incomes coming in, right. You got that lift one right there. So, and that's one where that would, to me, looking at this, not knowing what that is, I'd have a question about that. That 4305, that 7,084. What does that mean? Well, I happen to know that we have a lift station on site, and that lift station services our park and another park right next door, and that park pays 50% of all maintenance and operational costs. That is extremely uncommon. That is something that was like this weird small town or weird thing back in the 90s. Not a small town, it's Gary, but this weird handshake relationship that got put into they got recorded, and we had to go and fight this. But you wouldn't know that. So $7,000 in income, if you're like, where did that come from? That's a big deal. Okay, so then you have utility income. So when you see utility income, that's probably because there's a master meter, meaning there's one meter for water or sewer or both or whatever, and the landlord ultimately pays it, but the tenants are billed back either via sub meters or via flat fee or what's called a RUBS, ratio utility bill back system, meaning you say, hey, you have a bill, and it's whatever thousands, however many thousands of dollars, and you have 100 tenants in the property in the park, and you divide by those amounts of tenants. So if it's 2,000, you divide by 100 tenants, and it's $20 per tenant per occupant. So if one house has one person in it, they pay 20. If one person has four people in it, they pay 80. So it's fair, right? You're not charging per home, where one person in a home is not going to use nearly as much as four people on average, right? That's another way you can do it. Anyway, that's where that utility income comes from. We got the loans income. We have some rent to owns in that particular park, the 4,500 block there. Um, and then the prepayments, we had some people that paid early. Anyway, and then we got the expenses, a lot of them, right? We got management fees, we got snow removal. It's up in Gary, Indiana. Cleaning. We got legal stuff for evictions, and just uh, stuff that we dealt with the attorneys up there, and supplies and water and all that kind of stuff. So you see over here, the utility expense is in the, for water and sewers, 22. The lift station is 51. Yep. The reason I bring that up, that's the income, but then you've got all these other things. That's what I was trying to show you. So, okay, now we've got all these other expenses, right? And this is very detailed. Don't anticipate getting it like this from a normal buyer or a normal seller. We broke this out in ass bleeding detail so that we could know exactly where things are going, because we were doing a reposition, i.e. we were essentially rehabbing this property and burying it, and so we needed to know where everything was going, because we were dumping hundreds of thousands of dollars into this park to get it up to where it needs to be. So at the end of the day, you see these expenses over on the right here, 89,395. It's the 6,000 line. And then you go down and you see the total expense is $164,000 and some change, which gives you a net income of 93,000, right? Oop, $460. So our NOI is $93,000, right? Well, not exactly, right? Because remember we talked about above the line and below the line expenses. So what is one of these things? Hopefully you guys remember, a little knowledge check. What is a below the line expense outside? So we already talked about the interest and insurance, right? Or interest and principal for a mortgage. And what was the other thing? Well, the capital expenses, right? Those are below the line. So technically, you remove that from the total expense of 164,371, and you get our gross income, which was added up was $257,000. That's rent plus any other collections plus utility income minus all our expenses plus the $89,000 capex. Now that is something we spent money on, but it is not factored into the value because that goes as an improvement to the property. So technically, our NOI is $182,000. So when you divide that by the local cap, right, you get a much higher number than that 97,000 or 96,000.
So when you the local cap is about an 11 in that area. So we had an evaluation. We just got this appraised, was I think $1.65 million. So that's pretty decent considering we bought it at 575 a couple years ago. So it's gone up pretty well. Our investors were happy. And that's just goes to show you how you can force the appreciation, because it was based on nobody else in the area. Yes, the cap rate is sort of loosely based off of other properties in the area and the area economics itself. But that's something you can't really change or do much about. So it's kind of a no factor. It just is what it is. But by billing back utilities, increasing rents from 257 a month, which I haven't mentioned, that 257 a month, to now 330 a month, and then we just upped them to 350 a month. So those took no work. Essentially, it was just a stroke of the pen to change the lease. We increased the value, and we added a couple more tenants and stuff like that. But for the most part, all that value was created by just reducing expenses and increasing our income, which is awesome. So this is a rent roll. All right. So a rent roll is going to be so it has all our tenants on the left, right? Different people over here. It has their ID, what lot number they're in. This park is licensed for 106 spaces, but it doesn't. There's no way we could fit them in. That was back in like the 70s, and the homes are a lot bigger. And so they're kind of, some of them are skip units and stuff, and it's alphabet. It's just organized a little weird, but anyway. So you can see, like, garbage was $15 a month. That's a flat fee because we just divided the garbage by our 52 tenants. And the lot rent you can see as you go down here, there's 330, 350, 450 down here. The Annette, she's in a double wide. And then this other one down here, this Phillips, I think he is a rent to own. So he's at 450, and then you got the home rental, the repairs, lawn, all that stuff. All right. Ran out of film. Broke the camera there. Oh, so nothing interesting, man. Just making money. Okay, cool. So you can see down here at the end, you're going to see this recurring charges. So we got 51 tenants. We actually a rent to own, and then we've added a couple since this was actually put in this brief here. So you can see our net amount each month is $20,390. So that's what we should be bringing in on average every month if everything is going accurately. So we know so what you're going to do is we're going to now verify that with our T12, which is very similar to profit and loss, but it's over a 12-month period. So we're going to look for trends. Okay, so top, if we go to the 4,100 there, total rental income, you can see, okay, 15.9, 16.3, 14.9, 14, 17. I'll say that, like I mentioned earlier, some tenants, due to their financial situation, will pay when they get their tax returns. So some of them don't pay every month because they pay 3 or 4 months the previous year in advance, or half the year. And so those minor changes are okay. You're looking for those, 15, 20% or more changes. Lift station. So let's go to October of 2020. You got $3,069. Everything else, and you got July as well of 2,000. So what we had there was some pumps that went out. Right? I want to know what that, I know what that is, but that's because I own the park. But you're going to want to know what that is, because everything else is 0,0,0,0,0 for the most part. And so where'd that come from? Down here, look at that one. So total income in the month of October of 2020 was 33,112, compared to an average of about 20,000 or so, 21,000 throughout the year. And so why was that so high? Well, so we can read up the line and we see loan income. So we got home payment, right? So what we did is we essentially sold a couple homes to tenants, and they put a down payment on the property, and so on that home. So that was a big increase there. Totally normal, but we still want to verify that. We can probably infer based off of our knowledge of how mobile homes work and our experience, but you might not know that. Okay, now we got this other one down here. So total cleaning. What was the big cost here? Not a huge one, but I'd want to know if I saw that consistently go up. Okay. So now in this next one here, so now we're in CapEx. So here's where we go all the way down. I want to look at the bottom, right? I usually look at the totals first and I run left to right. So I go to the totals on all the lines, right? And I go left to right. If they all look pretty normal, I'm not too terribly concerned. But when I see weird things like CapEx of 8,500, 9,800, 13K, 10. I don't care, Mason. All that kind of stuff, right? That makes me wonder why. Because that goes down to this bottom line of net income. I see 5,800, 15, 4, negative 181. And then we go back into like the teens, right? That's our net teens, and then this last month in May, we'll get to that in a minute. But you look at that and you're like, why? Well, this is a question I would ask. The answer to this particular one is we demoed some homes. You can kind of see that above there, mobile home trailers. We demoed, let's see, in October. You can see that. We moved a home that line's cut off on in June, and we did some other things in those properties. Right. I'm actually not sure on a couple of these other ones. I know that we moved some homes, we demoed some homes and things like that. This isn't really coding, right? But I do know that those were pretty heavy months. But you can see at the end, you follow that total net income on the very bottom, left to right. You see that the total was 138. All right, so that's not too bad. But then you see this month right here, 21,000 almost. You're like, oh, that's a really good month. Well, look above it, everything's zero. This report was pulled in sometime in May, and the month hadn't completed yet, right? So that's why. But that again, I'd want to, if I didn't already know that, I'd want to make sure. So all right. Never trust, always verify, right? So again, assume the numbers, what the seller gives you are false until you can verify it. And so if they say, or a broker says, a lot of times a broker will say, oh yeah, market rent is, the rents are currently at $200. Market rent is, $450. You're like, sweet, that'd be awesome because that's a very easy valuation increase. But how does he know? He probably doesn't. So what I'm going to do is I'm going to call all the mobile home parks in a 5-mile area or so, and I'm going to pose as a somebody who wants to move in, ask if they got any rooms available. I'm going to say, hey, I'm looking to move in the area. Do you guys have any homes there? And they say, no, we don't. You say, do you have any, like, what if I had a home or an RV? Could I move it in there? I say, oh, well, it'd be $300 a month for the lot rent. You got to pay utilities. Okay. So that's pretty low. Now I call another one and they're at 325. I call another one, they're 250. So the average plus or minus is going to be about 300, not 450. That's going to drastically change my offer, right? Because that's going to be the average. Going outside of that area by even a few miles could be a completely different market. And so I have to take what's kind of in my market, that 5-mile range or so, within reason. You might go a little further, you might go a little less, depending on your market. Occupancy rates. I mean, if you're there local, best way to do it is just drive through, go through and see if they're actually occupied or not, and go through the other units. See what the condition is of the other ones compared to the one that you're looking at getting. If you're not in the market, call around and be like, and the same questions. Hey, you guys got any availabilities? Like, are there a lot of people, or like, is there like I'm seeing, these ones are pretty empty. Is this like kind of dead, or all these ones are full? Like, do you guys have some space? Oh yeah, we got tons of space or whatever, right? Do the same thing with storage facilities, right? I go and I say, hey, how much, I need a 10 by 20. You got any available? And they're like, oh yeah, we got tons. Or now we got one more left. And they're probably saying they got one more left to try and get you in there, but they might legitimately have one more left. And so you just need to, kind of figure out what the truth is. But okay, so here's some kind of interesting stuff that's very common with mobile homes and RV parks. Is number 3, the conforming versus non-conforming. So a property can be non-conforming, or can be illegal, an illegal park, but it can be legit to buy and use. So it would be called illegal conforming, or you can have an illegal non-conforming, or you can have a legal conforming. Legal conforming is, you don't have to think about it at all. Illegal conforming means it's basically the term a lot of people use is grandfathered, right? And so a park was maybe built a certain way or built in a location where it wasn't really allowed, but there was nobody called them on it back in the day. So it's grandfathered in. So when they sell it, it is illegal, or it is currently illegal, but it's conforming to the current code or the grandfather status. Now, if you change things, you could potentially become a non-conforming. So you got to be careful, and you got to talk with the county and the zoning and planning department about that. Um, and then obviously, if it's non-conforming, if it's illegal non-conforming, it's not it cannot be a park. They may be getting out away from it under the radar, but you can guarantee when you buy it, the county's going to come after you, and you're not going to be able to use it. We actually was that one in Panama City. We had one that we were told was when it transferred ownership, while it was technically zoned properly, their zoning, their code was or their zoning was when it transferred, when titled or when deed transferred ownership, it was not allowed to be a mobile home park anymore. So we were going to buy this waterfront mobile home park near a military base that was going to be awesome. We were going to, basically could be used legally as an RV park, and we weren't going to be allowed to do it. We'd have to build light commercial in that spot because it wouldn't transfer over. So that was a dead deal. Um, let's see, what was I getting at here? Obviously the cap rates, we talked about that. You want to know what those are, get a couple people to tell you what they are, and that'll help you identify what, based off of, after you get all your numbers, your income, your expenses, and then you can go and you check out, your caps and see what the value could be. Right, you see what it is, and we always make our offers based off on what it is, but you see what it could be and if it's worth the time and effort. Right. And like I said, you're probably not going to get all the information you need up front. You're going to have to go to contract, but you're going to want to do your best, make your best guess based off of what you know. Submit the LOI, and then go to contract. Put the EMD down, get everything you need. You can always get the money back, right? It's going to be very difficult to do commercial, no money down. It is possible to do some small deals, but if you get into some bigger deals or with sophisticated investors, it ain't going to happen. So just know that up front. It doesn't have to be a ton, but it's probably going to be about 2%, 2 to 3% EMD. So if you're doing $1 million deal, you can do the math. All right, so that is the end of the presentation. I'm sure I definitely glossed over some stuff here. I'm not going to stop sharing. Escape, yeah, right. Oh, sorry. Sorry, guys. Technical retardedness here. Okay, so I probably skipped over some stuff, or I maybe covered some stuff in too much detail. Now we're to the part where we got Q&A. I've got this fancy, drawing board here that I can help you out with any, like, if we want to do any scenarios or anything like that, or if you just have straight questions, I can try and answer it. So what do you got? Let's see. Let's see, probably, okay. So did we turn comments off? Because they literally just stopped. Like, oh, okay, cool. All right. Do you guys have any questions? Anything you want? Oh, what did I do? Anything you want to talk about, or anything you got to ask Tyler or myself? It's so good.
It's like dangerously good.
It's dangerously good.
Yeah. So any questions that revolves around, commercial real estate, how to run a deal? You went through all the really high level concepts, everything that you really need to understand at a really pretty high level. He went into the granulars of some things, but really it's just scratching the surface. Commercial deals have a lot of stuff going on. It's not as simple as like, oh hey, what's your comps? Oh, there's a single family next door that sold for 180, so that's what our ARV is. It's way 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 more granular. But the whole reason why we get into single family is to grow into multifamily and to be able to make deals happen. The other big benefit to multifamily deals is that it enables us to find the deal and literally still gain an extreme amount of wealth and an extreme amount of cash flow without even actually spending any money, which isn't the same with single family residents. So if you guys have any questions, put it in the chat. We'll maybe do it leave it open for like 3 or 4 minutes or so to be able to ask any questions in the chat. If you guys have any questions moving forward, for any people who might have watched this, later, simply reach out to us. You can go to Facebook and message in the REISIF Mastermind community and just tag Jake Chambers or myself in that community, or you can reach out to us directly. We do have a actual workshop that is going to be probably later this year. Again, we went to go do it this weekend, but just people's timelines didn't match up. Everyone could only make the first day that was wanting to come, which is really ironic. So it just didn't make sense to, charge for a workshop and then only have you for half the day or anything. So we just decided, let's just give out some free value. Even though it can be boring for those that might not be really too entertained in it. Once you get good at it and you understand it, you feel like you're kind of like this magician that just can work around, the county and figure out where you can find money in the deal. So I don't see any questions coming in, but I see 19 people, 20 people as of right now. So
We're all gonna disappear here.
yeah, I'm like, just gone. So again, this was fly off the whim. We just wanted to get it out there. And get people starting to think about that in this community. And here's the big thing. I don't know if Jake covered it or not, but one of the biggest things I want you guys to think about for those that are REISIF users is commercial is just not a big fucking skyscraper, right? It's also 20, 30, 40, anything more than 5 single family residences purchased in a portfolio would be considered a commercial deal. So uh, in your REI SIFT accounts, you can find. I mean, shoot, I was just on a live last night with someone from 9:45 until 5:30 in the morning. And the very first deal we came across when setting up their REI SIFT account was an owner that owned 118 properties in their account. That's a portfolio purchase. That's a commercial deal. We got another REI SIF member. I'm not going to mention his name, but he's working a 500 property portfolio right now, $30 million purchase. I mean, that's insane. That's life changing deal. Like that's a deal if you can get equity in it. That's extremely life changing. That's not a little thing. You can work on trying to find these deals where there's single family residents that have portfolios. And instead of having to get 10 deals a year, one at a time, it's one person, 10 deals, right? It's a beautiful thing. So um, go back through this, skip through the slides maybe you didn't understand, and then send us some questions. We will be sending out a better timeline on when the commercial mastermind is going to happen or commercial workshop, so people can come here in the office and actually learn in person and go out to dinner and talk about these things, and then really build a group of individuals who are truly interested in the commercial side of it. So um, if you can in the chat though, let us know, is this something that you'd like to see more content on? We can have Jake come on and just do some more smaller, like 5-minute videos on tips and tricks on how to do certain things. Let me know in the chat, because otherwise I'll just say, fuck off, and we just won't do it at all. But I want some confirmation that this kind of content is something that would be okay for us to continue to build out in the REISIF community as well as the other platforms. And I'll give like 30 seconds for someone to say yes. And if not, I'm just going to fucking throw my laptop. So Dylan, react. Let's see. I'm going to check to make sure it's just not.
I feel like it's like not working because
Yeah, it's like
it like was going hot and heavy and then just stopped. Oh, there you go.
There you go. Looking forward to any mastermind events. Oh, there we go. Yes. Okay. So it's just delayed. It's really lagged. Okay.
Yeah.
I knew Dylan. I knew you're in here, Dylan. I knew I could rely on you. Cool. So please keep me posted on commercial webbies. Okay, awesome. So we'll continue to work out content. I think Jake mentioned earlier that he's leaving the Marine Corps and really doing real estate full time. So he'll be in the office here multiple times a week, and we'll probably create a thing where we're gonna at least one of those days a week start doing like a weekly commercial, tip, because it's selfish, right? From my perspective and Jake's perspective, it is a little selfish, right? We want you guys to get interested in commercial and what's possible, because we want to be able to provide you data. We want to be able to do things for you guys that enables us to make you find deals so that maybe we can buy them, right? Maybe we can give you guys $100,000 assignment check. I'd love to give you 100 grand. Trust me. If we can buy a deal and it makes sense, and we want to be the ones to kind of help you guys get there. Um, if you guys come here in person, you'd also meet Jake's other partner in one of his other companies that works a lot in the legality side. I'm pretty sure of everything. Contractual stuff, which is where everybody starts getting in the mucks and the waters, and so we're looking to kind of help build that out. So
I'm gonna do. I think the next one I'll do is just do a deal breakdown of the Crestview.
Yeah, that's a good idea. So we'll do that. Maybe next week or the week after, we'll do a actual full deal breakdown of our 100K assignment and what we did, what it looked like, how many times we followed up with them, and the whole gamut. And then the issue that we ran across, they have to save the deal, was huge. So anybody have any last questions? I'm going to give it like a minute because I realize that it is delayed. What you got? Shit ton of profit law notification. Retained, new customer.
There you go.
Downgrade, upgrade.
It's not downgrade. Oh boy, dude, my phone was blowing. I think
Yeah.
it's like.
Yeah, trying to. Oh no.
I hope.
All right, it looks like there's no questions. Y'all, I appreciate it. Thank you guys so much for sitting here and listening for a while. I know you guys are gonna start seeing Jake a lot more doing these types of things, and we'll get him used to the technology aspect of things.
If your guys are in the area, come out here. This is like so. I mentioned like my partner Blake, but I've got a couple other guys who I have as mentors. Like I'm serious. They spent hundreds of thousands of dollars on their education. I was fortunate enough to be their partners, and I've learned a ton. But I've done it through just like grit and exposure. Whereas they've been able to have that. So we all know we pay for our education, whether we pay for it or whether you pay for it in frustration and stress and heartache and your wallet because you did something wrong. We've all done it. We've all done it. We've done it both, right? Both ways, and multiple times. You never learn, and even the best guys out there screw it up. We had partners who are their 9-figure net worth, and they lost over $1 million last year in EMD from a deal. Now, granted, the economic situation that happened when a week before they were supposed to close definitely had a hand in that, but like they screwed up some stuff, and it happened. So don't think that any question you have is stupid, because I've probably asked it multiple times, and I'm sure that you're going to ask me something. I'm rubbing my shoulder because I feel like somebody shot me, dude. Anyway,
We do have bullet holes.
I know we do have bullet holes in the office. No, we don't. Well, kind of do. But anyway, yeah. Maybe I'll do a story on the drive-by that happened by one of my rentals last week. But anyway, so yeah, feel free to ask the questions. There's no dumb question other than one unasked, right? So you can hit me up offline. Just hit me up on Facebook, like Tyler said, tag me or whatever, and I'll reach out to you, personally. That way, I'm not, pushing this out here and you can't have something to write with or whatever. So just let me know. I'd be happy to talk with you. Sit down and break a deal down with you. We can raise capital for those deals. We have investors in our properties who have done nothing other than bring other people with money to our deal, and they just get a check every quarter. It's going to be obviously less than if you invest $100,000 or if you do all the acquisition and underwriting and close it and negotiating. But just bringing somebody to the table and getting a few $100s a month, it's pretty good. You do that a few more times, and you're doing pretty good. And if you get like that $30 million deal, if you bring money to that one, you're talking about thousands and maybe even tens of thousands or hundreds of thousands of dollars over the course of that deal, just for bringing the deal to the table or bringing money to that deal. So that's the great thing about commercial. There's so many ways to make money, and it really is a team effort, and it's very difficult, or it's very infrequent that people don't do it with a team.
Yeah, and it's important to do it with a team because, and it's kind of the last note, because I know you guys probably have dinner and everything, is um, if you like fuck up on the real estate side, you're not like raising money and doing all that kind of stuff. Like, it's no different launching a company on the NASDAQ than it is raising funds for a commercial property. It's the same type of thing. When it launches on NASDAQ, the money that's raised is the same thing as raising money for a commercial deal. There's no difference there. So the regulations that revolve around it are just as stringent. If you fuck up on it, you can go to prison for a long time. Right? So that's why it's nice to be involved with people that have the connection with the attorneys, have done it before and understand all the ins and outs of it. Because if not, you can find yourself putting yourself in a really bad position that sets you back for years and years, compared to just doing it the right way from the beginning. So thanks, guys, again. Appreciate it. If you guys have anything, reach out to Jake Chambers. You can tag him in the community or just message him, add him as a friend on Facebook. If you message me about it, I'm probably just going to say, hey, reach out to Jake. So, because I'm not as savvy as he is into stuff. So, y'all, thank you so much. Appreciate it.